The US national debt has been steadily increasing over the past century, with the country's total debt surpassing $35 trillion in 2024. It accounts for approximately $104,825 for every single person in America. Moreover, it is increasing at an alarming rate of roughly $1 trillion every 100 days. The country's growing debt is fueled by various factors, including persistent federal budget deficits, wars, economic crises, tax policies, and rising entitlement spending. As the US debt continues to climb, concerns about its long-term impact on the economy, interest rates, and future generations have intensified. The debate over how to manage and reduce national debt has become a central issue in US politics. In this video, we will talk about why the US is such an indebted country and what happens if the US defaults on its mounting debt burden. How did the US debt get so high? The United States national debt has grown significantly over its history, shaped by major events such as wars, economic crises, and policy decisions. From the Revolutionary War to the present, the debt has risen from about $75 million in 1790 to over $35 trillion in 2024. The US national debt began accumulating shortly after its independence, with the Revolutionary War leading to significant borrowing to finance the war effort. Throughout the 19th century, the debt increased primarily due to wars, including the War of 1812 and the Civil War of 1861, which saw a dramatic spike in debt. By the end of 1865, the US interest-bearing public debt stood at $2.2 billion. Moving into the 20th century, World War I and the Great Depression further inflated the US national debt, with the latter prompting massive government spending under the New Deal to combat economic collapse. World War II marked another significant surge, pushing the debt to unprecedented levels as the United States financed the war effort on a global scale. By the end of World War II, the US national debt had surged to over $260 billion, reaching approximately 120% of the country's gross domestic product. In the post-war period, the debt-to-GDP ratio initially declined due to economic growth, but it began rising again in the 1980s due to tax cuts, increased defense spending, and expanding entitlement programs. The 21st century has seen further increases driven by the wars in Afghanistan and Iraq, the 2008 financial crisis. Toward the end of the 2008 financial crisis, the US national debt had risen to nearly $12 trillion, more than doubling from $5.6 trillion in 2001. By the end of 2022, the US national debt had soared to over $31 trillion, more than a 250% increase from the $12 trillion level seen at the end of the 2008 financial crisis. As of 2024, the US national debt has reached a historic milestone, surpassing $34 trillion, which is 125% of its GDP, and continuing its upward trajectory, fueled by ongoing government spending, tax policies, and economic factors. What are the reasons behind surging US debt? The US consistently spends more than it earns, a situation known as a fiscal deficit, where government revenues fall short of its expenditures. It is the primary factor behind the surging US debt. It can be understood with an example. Imagine you run a household where your monthly income is $2,000 but your expenses are $3,000. Every month, you're short by $1,000, so you borrow that amount to cover the gap. Over time, these monthly borrowings add up, increasing your total debt. Similarly, the US government often spends more money than it collects in taxes and other revenues. This shortfall is called a fiscal deficit. If we look at the US federal budget 2023, we can clearly see that the US federal budget had total revenue of approximately $4.4 trillion, while expenditures reached around $6.1 trillion, resulting in a significant budget deficit of $1.7 trillion. To cover this budget deficit, the government borrows money by issuing bonds. As these deficits continue year after year, the borrowed amounts accumulate, leading to a rise in the national debt. The US is experiencing significant demographic shifts, with approximately 10,000 individuals turning 65 daily through 2030. By 2030, the projected senior population is expected to reach 71 million. These demographic trends put upward pressure on the federal budget by increasing government spending on entitlement programs like Social Security, Medicare, and Medicaid. Moreover, rising healthcare costs are becoming one of the fastest-growing parts of the US federal budget. The US healthcare system is the most expensive in the world, as the country spends over twice as much on healthcare as other advanced nations. The average healthcare cost per person in the US is $12,555, exceeding that of any other advanced nation. In addition, lower tax revenues due to tax cuts and economic downturns failed to generate enough revenues to cover the spending. Therefore, the growing imbalance between revenues and spending leads to budget deficits, and the result is an increase in US national debt. Now the question is, how does the US balance its fiscal deficit? The US balances its fiscal deficit primarily through taking debt from different sources. Of the total US debt, about $27 trillion, or 79%, is held by the public, including domestic and foreign investors. The remaining $7.0 trillion, or 21%, represents the intragovernmental debt held by government accounts, primarily the Social Security Trust Fund and other federal programs. In other words, about two-thirds of the US debt is held by the domestic holders, which includes individuals, banks, pension funds, mutual funds, and other financial institutions. Moreover, a significant portion of this public debt is owned by foreign countries. Japan, China, and the United Kingdom hold a significant portion of the US debt, with Japan being the largest foreign creditor, owning around $1.1 trillion to the US. The rising national debt has significant implications for the US economy. Every day, the US spends $3 billion just on interest payments, reflecting the high cost of servicing its growing debt. Interest payments are becoming the fastest growing part of the US federal budget, which is projected to double in the next 10 years from where it is today. The high interest payments reduce the resources available for other essential areas like infrastructure, education, and healthcare. As the national debt continues to balloon, interest payments on that debt are projected to become the fastest growing part of the federal budget. The rising national debt is threatening the US dollar status as a global reserve currency, which could potentially lead to a fiscal crisis. It also limits the government's ability to respond to future crises, such as recessions, natural disasters, or national emergencies. As the debt continues to mount, it also undermines investor confidence in the US economy, potentially eroding its long-term resilience and stability. Imagine a scenario where the US debt keeps increasing and, at a point, the US defaults on its debt. Such a situation would trigger a financial crisis both domestically and globally. The government's failure to meet its obligations would likely cause a sharp rise in interest rates, a plunge in the stock market, and a loss of confidence in US financial stability. This could lead to a severe recession, higher unemployment, and a downgraded credit rating, making future borrowing more expensive. The ripple effects would also disrupt global markets, as US Treasury bonds are widely held as safe investments, potentially leading to a global economic downturn. Moreover, if the US defaults on its debt, it could undermine the dollar's status as the world's primary reserve currency. Today, the US dollar is the largest reserve currency in the world, held by central banks and financial institutions globally as a safe and stable asset. Addressing the US national debt requires a multifaceted approach. One solution is to reduce the federal budget deficit through a balanced approach of spending cuts and revenue increases. Additionally, implementing more stringent debt limits or fiscal rules could help ensure that future borrowing remains sustainable. In conclusion, the rising US national debt presents a pressing challenge to the country's economic future. While the debt has been a necessary tool for managing crises and funding essential government programs, however, its continued growth is unsustainable and threatens the nation's economic future.